Okay, in this section of the class, what we're going to do is we're going to talk about risk and return. This is going to be one of the most interesting parts of the class, in my opinion. Some of you might disagree. You might find none of this interesting, in your opinion. Okay, but let's just go through maybe the history and talk about risk and return. I think a picture is worth 1,000 words here. So this blue line here represents if you would have invested $1 in, to say, the S&P 500. The S&P 500 didn't exist at this time, but the 500 largest stocks. Okay, if you had invested $1 into the 500 largest stocks in 1925, what would they be worth by the data here ends in 2006? Likewise, if you had invested in the smallest 600 stocks, so this is, you can think of this as being the S&P 600 small cap index, what would that $1 become after, from 1925 to 2006? Again, I don't have the most recent data, but it's not that important. What I want to show you is that, notice that the price movements of the purple-ish line, I guess that's purple, are much more volatile and much more sharp than the price movements of the blue line. Does that make sense? And so you can see that the volatility of the purple line is greater than the volatility of the blue line, suggesting that the riskiness of holding small cap stocks is higher than the riskiness of holding large cap stocks. And therefore, you should, in theory, be compensated as an investor if you were to buy small cap stocks than large cap stocks. I hope this makes sense, that if you buy riskier stocks, you should expect a higher return. You need to be compensated for that risk. Look, the black line is long-term government bonds. And you can see very little price movements. I mean, there's very little volatility in the black line relative to the blue line, and certainly relative to the purple line. Notice this green line are T-bills. You can hardly see any volatility. I don't want to jump too far ahead, but we use short-term government bonds as a measure of risk, as a measure of the risk-free rate in subsequent discussions that we'll have. So you can see the difference between virtually no volatility if you were to buy short-term government bonds, a very slight amount of volatility if you were to buy long-term government bonds, much more volatility if you were to buy large cap stocks, and the most volatility if you were to buy small cap stocks. So we're going to talk in this section of the class about the relationship between risk and return. We'll talk about risk aversion. We'll talk about behavioral issues related to loss aversion. I'll share some of what I think is interesting research about how we as humans view losses. And if there was ever a time to understand or talk about loss aversion, that time is right now, as the market has literally imploded in the last 2 weeks because of the coronavirus. Think about this. We have had the worst 2 days of market decline that we've seen since 1987, since October of 1987. That has now surpassed the recent financial crisis. All right? So we talked in class when Hank Paulson is trying to put together a bailout package for Lehman and wasn't able, the CEOs of the major banks of the world, they came together and they couldn't get the deal done over the weekend, and trading opened on Monday. We find out that Lehman is going to go bankrupt. The stock market imploded. We have now witnessed 2 days that have surpassed that day in the last couple of weeks, right? And so talking about loss aversion, this is where people deviate from what we as economists would call traditional rational models, and their loss aversion takes over in their trading, which might explain some of the craziness that we've seen in the stock market. So this will be a fun section of the class. I would encourage you to watch all the videos. Some of this stuff is computational, certainly some is conceptual, but it's important for you to watch all the videos so you get an idea of what's happening.